Okay. Good morning, everyone, and a warm welcome to AECI's interim financial results presentation for the year ended 30 June 2023. I'd also like to extend a warm welcome to our esteemed board members who have joined us this morning. Please take note of the usual cautionary statement. We will follow the similar agenda that we normally follow. And then we'll take questions right at the end. But I think what you will see during the presentation as our executive present today is that just again the results demonstrate the resilience of our underlying businesses that have had to operate in a very challenging environment. So with that said, I'd like to give the mic over to our Group Chief Executive to kickstart the presentation.
Thanks, Anita, and warm welcome from my side to everybody that made it here to our headquarters and those out in the online, in Teams, wherever you are. Let me start as usual. You know that safety is our first priority, and even if it says disappointing safety performance, there is not a word that can describe what happened to us in the first 6 months, which also was a real emotional shock for the entire organization, as we lost 2 colleagues in work-related incidents, fatalities. And also we had a colleague that experienced a life-altering injury. And that really dragged down the organization, I can tell you. And we are doing our utmost to recover and come back to the really world-class performance that we have had before, I would say. We have taken immediate interventions, but also trying to focus again more on long-term programs to improve our safety, specifically leadership, from a leadership culture aspect. If anything good on that slide, then that the last 3 months there was no serious incidents, and I can only hope that those 3 months are the start of a longer period. Also very important and increasingly important is our ESG targets. So where we are at in the moment against our 25 targets. You can see on the gender target we have achieved 75% of where we are planning to get by 25, which is 40%, so we are in the moment at 30%. So goal achievement 75, and we are very, very optimistic that we can reach that goal. Effluent discharge at 47% of the goal, which also means that we are in a good progress and that we really believe that we will also deliver on that. And the same is true for carbon footprint, even if it's the lowest number here, but we are spending a lot of efforts specifically in also investing into renewable energies, which then drives our carbon footprint down. So let me talk a little bit about the business. I will just give a highlights from a group level perspective, and my executive colleagues will then go into the businesses. So overall, the group displays solid results in the first half year, driven by our core businesses. There are other activities that are currently underperforming and not delivering to our expectations. However, for all those businesses, we have countermeasures either in execution or in planning, and we are optimistic that we will be able to improve those results significantly going forward. There are 2 areas of particular concern which are being addressed now. The one is our elevated working capital, which is due to different factors, and the first one is it is a result of our growing business and a growing top line, specifically on the mining side. But that we consider a good working capital because it supports our growth. The second is a higher than usual stock, and that is in both raw materials and also in finished goods. Those higher stock levels were decided from the management some time back to ensure supply to our customers in anticipation of potential supply disruptions. And that was mainly for ammonia. But there was also an element, and I'm coming back to the ESD a little later, but in one of our announcements you have seen that we had a dispute on the back of our ESD from 2012, which vested without value, and there was at the point a risk of potential work interruptions. And at that point, then we decided, but I'm coming back to that, also to an ex-gratia payment. But more important, related working capital. At this stage, we put more finished goods into our warehouse to ensure supply to customers. So going forward in the second half, we definitely expect that we will get that through the business. So those inventory levels will definitely reduce. So the third element was and is an elevated level of receivables. We have increased our efforts to collect, and we are on a good way, and the colleagues will refer to that later. But still, there is work to do, and we come back to that a little later. So the second area that requires high management attention is our elevated gearing level, which is driven not only by the higher than usual working capital, but also a result of previous capital allocation. And I want to mention two here. The one, the Sherm acquisition 2018, and the other one, the elevated dividend paid in 2022. What I want to make very clear, to not confuse anybody, we do not see our gearing level as critical. So we are very confident that the business is and our financial situation in a very healthy state. But we don't like it. We don't like to be at the current gearing level because it then our CFO will later show how much it costs. There is financing costs involved that we don't like. And also we want to prepare for a new maybe cycle coming specifically in our mining business. And then we want to be prepared for growth as well. So that's where we want to go. Having talked about the Sherm business, so this chart shows both the Germany business as well as the US business. And we really need to look to those businesses differently. So while the US business is delivering significant growth, both top and bottom line, and also on the back of the investments we have done, the Germany business continues to underperform. So the restructuring plan that was developed and approved end of last year is progressing well. And really, I have to say, the colleagues doing a tremendous job there. So you know that one of the elements of this restructuring plan is closing a factory, 1 out of 4. And this is a big job, and today, until today, and also going forward, we can say this is going very, very smooth. So there is no interruption, no nothing, no disputes. Everything goes very, very well. And we believe that this process will be closed by end of the year. Yet, what we also need to see is that the results of this restructuring will only show 24 and later. So that does not make us happy. So if you look to the chart, what you can see is that actually on an operational basis, the business has not improved from year over year. Again, that's because the results from the restructuring come only later. But what you see is that the turnaround cost driving the business further into negative. So what we have done now, we are also We have put additional measures into place, also looking more into the short term to improve the business. So on top of that, we continue to evaluate and consider all other options to reduce the negative impact of the SHRM business to the group performance. So AECIs continue to be committed to the triple BEE goals, specifically the ownership goals. As previously announced, 2012 EST vested without value, besides the dividends that we have paid over the period to the beneficiaries. But as I already mentioned, this led to a dispute with the beneficiaries and resulted in a threat of a potential strike action. To avoid a work interruption, the management made an offer to the beneficiaries based, and that is important, based on a business case, comparing to potential opportunity losses of a work interruption. So that offer was turned down by the unions, and finally we ended up in court, but we received a court interdict. But management and board decided in the spirit of the EST and to restore goodwill to approve an ex gratia payment to the beneficiaries of 106 million rand. We strongly believe that without such a decision, the strong performance, especially in our mining business, would have not been possible. So with this, I give it to our CFO.
Thank you, Holger, and welcome to everybody here present. Special mention to our bankers, investors, and our board members, and to those who are online. I'm very happy to report we had a strong revenue growth of 19%, really supported by our core businesses. And that revenue growth of 19% carries through very nicely through to our EBIT. In terms of supporting our results, we've made a good CapEx investment, albeit a bit less than the previous year. But what is pleasing is most of that investment, 55% of that is in growth CapEx. And a lot of that is to support our mining business in terms of the Australia, Indonesia business, as well as closing out the investment we did in SHRM USA. To support the revenue as well, our working capital has come down slightly by 3% from last year's 22 to 19. And that helped to support our revenue. And as previously mentioned, there's a big focus around bringing that working capital down, and I'll elaborate that further on in the slides. So whilst we've delivered a good EBIT growth of 20%, you'll see it doesn't carry through to our headline earnings per share or earnings per share, where we only see 5%. And this effectively now takes me to the red zone of the dashboard, where you can see our financing costs is up 121%. And that's really to cover the legacy debt that we're carrying for the acquisition of SHRM and the continued turnaround of SHRM, as well as our elevated working capital. And of course, we're currently in a high interest rate cycle. With the gearing at 47%, it remains within our previously communicated guidance of 40 to 60%. And with the current high interest, we would like to bring it down. We're going to do that trying to address three key areas, really revisiting our capital expenditure. We have capital commitments as already in the financials, but revisiting that and really focusing on our maintenance capital, but also scrutinizing our expansion capital, growth capital, and really prioritizing that to our core businesses, and provided they deliver the returns in excess of WACC. Also addressing our working capital is our second point. We'll go further that in the next slide. And then with that, taking into account the focus on CapEx as well as working capital, we've modeled that to say, right, to what gearing level could we bring this down and what could we support in terms of a dividend. And based on the capital available, we could support a dividend, which was supported by the board, of 100 cents. So in terms of our working capital, you'll see the ratio has improved. You can see it from last year at 22%, and it steadily improved down to 19%. If you look at the monetary values, it sort of moved sideways. And there's been a strong focus in the first half of this year around our debtors, and you can see the ratio, the cover days have improved accordingly. The area that remains of key focus, not that we're saying we mustn't focus on debtors, is our inventory. Our inventory remains at elevated levels, although it has come down moderately, but that remains our key focus area. In terms of our borrowings, we finished off at the end of June at 5.7 billion, and with a gearing ratio of 47%. And really like to highlight on this specific slide here is, whilst the business has continued to generate good cash, the dividend declared had negatively impacted our gearing result for the 6 months period. And then just lastly, just to give you an overview of our current shape of our borrowings, we have a net debt of 5.7. There's currently a program of work to refinance that, and we're making good progress. We're introducing sustainability-linked ESG targets to this, and effectively of the 6.4 that's due for renewal, of which 2.6 is short, we'll be refinancing 3.8. I think I'm happy to report that we still remain comfortably within our covenants, and you will see a slight deterioration on our EBITDA to net financing costs, and that's really due to the high increase or the increase in our financing cost. And I'm happy to report that we still have an A+ GCR rating with a positive outlook. And at this point, I'm going to hand over to the business. I'm going to ask Mark Cathan from Mining to come up. Thank you.
Morning, Chair, non-executive directors, and to all the shareholders and bankers out there. The mining results that we presented and published this morning. Oops, maybe I need to flick that on. There we go. Were really good and strong results, and that's kept up with the momentum that we delivered in H2 last year. And that momentum has been driven by very strong revenue growth, a revenue growth of 29%. Now, we had some of that last year where we struggled in the first half was due to rain that we had in Mpumalanga and the coalfields. We had strikes. That did not repeat itself. So there was some gain on that. But more importantly, there's been strong volume growth. Strong volume growth in South Africa. We delivered a 30% volume growth in bulk explosives. We delivered volume growth in the DRC in Africa, as well as strong growth in Asia Pacific, more specifically in Australia, and really solid growth in Indonesia. Both in bulk explosives as well as in initiating systems was strong. And more specifically, we are very pleased with our growth in electronics. And electronics is part about, it really enables us for future global growth going forward. When I come to mining chemicals, we have seen a softening of commodity prices there, but we've been able to maintain our profitability on the back of our rand-dollar exchange rate, and also demand from our customers, albeit in some areas was impacted by load shedding. Our revenue, now 69% of our revenue is outside South Africa, and that is really testament to our strategy that we've put out there, and that's to grow our business internationally across the globe. So all our CapEx investment that we've put out for our businesses, and strong growth CapEx has been invested in places like Australia, now South America, and parts of Africa. That is all following our geographic expansion. Our EBIT, I'm proud to say, is up 46% on last year, and we have put in some really strong cost containment drive in our business, which we'll probably complete towards the end of the year to sustain us into the next 6 months going forward. Our EBIT margin has improved by a percentage point. We still haven't quite reached our target. We believe it's beyond that. And as ammonia comes off, our EBIT margin should improve. However, more importantly, we'll be able to utilize our plants much better to grow that EBIT margin. And our operational team has been very successful, both in mining chemicals as well as in the ammonium nitrate facilities, been able to achieve really good production efficiencies out of that. Working capital, Holger's theme, and has been very strong on us controlling working capital. We have increased our stock levels through the half year to avoid industrial action. That we should be able to see normalizing as we get into the end of the year. If I look at our outlook for the next 6 months going forward, we've got a really strong pipeline of tenders out there, not just in South Africa, but right throughout the globe, Australia, South America, as well as in key parts of the African continent. Recently, we have signed up 3 significant 5-year contracts in Australia. We haven't seen the performance of those contracts coming through these results, and hopefully in the second half, we should be able to see that improvement coming through. The mining chemicals business, likewise, have been able to renew and extend all their contracts in the business. Capital investments I've spoken about, and what we see very importantly is we don't see any big shifts from our point of view on the commodity prices where they are today. For the next 6 months, we still believe that they will more or less be the same. I'd like to call up Dean, that will come up and discuss the water business.
Mark, and before I greet everybody, it's always a tough task to follow the mining team with these excellent performance, and we wish you well for the rest of the year. So, good morning to everybody, and to avoid anything, let's just say all protocol observed. So, quite pleasing results for water, but I will start off just with the area of concern for us, which we've been working quite hard on, is the working capital. As I explained in our March feedback, that we had to increase our inventory and cover because of some extensions on our public water business. Subsequent to that, that stock is now being consumed at the right rates, not as much as we would, because as you know, the summer rainfall season is not exactly as it was the last season, but more so the turbidity and chemical demands in the public water has subdued somewhat the volumes this year compared to previous years. The other area that we consciously do is our exports is all on LCs in the public water space. So there's been some challenges on Forex on the continent, so we have pulled back some of these volumes as well. The result of this is that we have stopped importing for this half of the year, so creditors' days have come down dramatically, but I think pleasingly over the last 8 months our inventory levels have come down by more than 200 million rand. So that hence is also one can see in the first 6 months we had a very positive cash generation in the water business. If I speak totally now on the rest of the business, revenue up 8%, and the pleasing part has come from the mining, water treatment chemicals, as well as industrial. And this is the first time that we've seen industrial make a pickup. And you know, many times I've used, which often people say the excuse of oil and refining, but it's pleasing that this season that the oil and refining sector is certainly through market share growth locally, as well as growth on the western part of the continent. Those are really starting to generate some, and we've got some nice projects which I'll talk about on the next slide. The main thing that I was really struggling with last year was quality of earnings, and we had promised not only the board but all our stakeholders that we were doing a lot, and I can see it already coming through. You will see the quality of the earnings with an 8% revenue growth. We've converted that to 21% EBITDA and a 26% EBIT. So quality of earnings has improved. EBIT margin has moved from 10 to 12%, and we are still targeting and focusing to improve that further as we continue. The slide on the right just shows that the water business for the last 5 years is running on a CAGR of 11%, but if we look at it in the terms of the last 3 years, it's 18%, and that's more or less what the business is targeting to continue to grow this business. If I look at the outlook, and I didn't speak too much about the green products and the greener technologies, the water business is really trying to make ourselves more independent of only international technology. That's the basis of our business, but to grow our technical capabilities and competencies. And these technologies we've launched 2 this season, which are now become regular business. We've got quite a few more coming up in H2, and we're really excited as to where we're going with these technologies. The advantage of this, it's not competing with another party. It's new technologies that we are bringing in that are enhancing our customers' business as well. So these are actually, the adoption rates are certainly much better than when one competes for the same thing. The quality of earnings is also going to enhance the water business going forward. So we expect for the rest of the year, the revenue to continue to grow, the quality of earnings, the margin improvement, as I've said to you. We have placed some orders for H2, which are coming at a substantially better pricing and will also yield better margins for us. I think when it comes to the sustainability projects, in the last 12 months, we've been awarded more than 10% of the last 12-month revenue in sustainability projects. A lot of them have been executed, but we still got at least 50% of that to be executed in H2. And these projects are actually growing because as we now enter this market, the familiarity of the water team and the customer base is growing day by day. So we're quite pleased with that. And we think, as I promised, I think in March, that this year will be a good year for water. And with that, I'd like to hand over to my colleague, Mr. Murray.
Dean, welcome everybody and to our board members. And so thank you very much to my team that are also online for tough trading conditions in our chemical business last year. But I'll go through and unpack that for you. I think first of all, you'll see there that our revenue down by 4% to just around the 2.8 billion rand. And really the revenue was impacted by a drop in some of our commodity prices, particularly our sulfur price. I mean, you will recall that rocketed up to about $600 a ton. So that's right down now to probably about 90. The other important thing, of course, is we've seen a lower demand in our food and beverage business as well. And I think that's really on the back of the cash-strapped consumer that we've seen in South Africa. And then also some challenges in the US market with our sands fibers business. And of course, that's really based on the softened textile market that we're seeing currently in the US market as well. Of course, EBIT and EBITDA down. EBIT down 26% and EBITDA 17%. And that's really impacted by margin pressure that we've seen in the market. There's a lot of competitor activity as we see a lot of our competitors also destocking because we have a lot of high inventories at the moment. And we're also making sure that we reduce ours accordingly. And then, of course, the other big impact for us was one of our big customers in our specialty chemicals business, Fosco, and I'll talk about it later. Their plant was down for just over 3 months because there was a problem with the crusher. And, of course, that's due to come back. In fact, it has already started up again. And we expect to make those volumes and those sales up in the second half of the year. But very importantly, of course, still good cash generation in our chemicals business as well. You'll see our EBIT margin is slightly down and working capital up a little bit. But there's a strong focus as we wind that down going into the second half of the year. Just having a look at a little bit of detail in the businesses. In our specialty chemicals business, you can see revenue up and EBIT down. Very good performance on our traded portfolio. We've been able to retain customers that we had last year and very good margin management in this business as well. The manufactured side of the business down was the Fosco plant, but as I've mentioned to you, that will ramp up second half of the year. And also that's also one of the reasons why our inventories are a little bit higher, because we buy some key raw materials for them as well. And of course, we'll put that into production in the second half of the year. Industrial chemicals, the underlying business is still, I think, very good. Although the revenue down in EBIT, there was a couple of anomalies that were sitting in the numbers of last year. We had the SAPREF volumes, which are in there. sales of molten sulfur, which were not repeated in the first half of this year, as well as some insurance claims that we got last year, which we haven't had the same year. But again, a tough macroeconomic environment. Probably the one area of our business which is really challenged at the moment is the home care business, the soaps and detergent markets again. And then on the food and beverage side, you can see revenue up just a little bit, which is really on the back of commodity prices, particularly in the juice business. However, the EBIT down by 26%, as we've seen consumers are battling with cash at the moment. But I think one of the good things, and I'll talk about it later, is just the investment that we made in the clarifying plant is already delivering the results that we've anticipated. Lastly, of course, I've mentioned Sands, and again, that US textile market and some stock write-downs there. So we're hoping that, and it's mainly in the apparel side of the business, and we're hoping that we're expecting that to turn around in the quarter 4 and early next year as well. So just on the outlook, again, that strong focus on the working capital. We still continue to expand our product range using our sourcing channel through the China office, as well as new agencies that we've been able to bring aboard. So we are still a desirable partner for international manufacturers to represent them in South Africa as well. Again, we've got a very strong project pipeline that we've developed through our strategy process that we embarked upon 2 years ago. So good customer retention and margin retention in certain businesses. And of course, I've mentioned the CapEx that we invested in the food business, which is really yielding the dividends that we expected. And of course, there is a big cost program on at Sands Fibers. The new equipment that we ordered, which was the last of the single-stage spinning machines, that will go in it by the end of August. That will be up and running as well. And what that means is quite a big reduction in your human capital that will be used on the plant as well. So I think we've got a solid plan to take cost out for that business, readying ourselves for 2024. Then on the agri-health side, there we've had a solid performance again. It's really a good flow over from the back end of last year. And of course, this is the South African agri-business. Again, you'll see the revenue up 6%, just onto that 1.9 billion rand mark. EBITDA up 7% and EBIT up 5% as well. And really, I think even the working capital, we've done a very good job in managing that working capital, managing the farmers, the debtors collection, which I think we've done fairly well in this business. But I think what we really saw was a robust quarter 1. And I think that really helped us for the first half of the year, because generally, as we go into the winter months, that's when our sales really come off. But we've poised ourselves, I think, we have an optimistic view for the second half of the year. We've had good rainfall, so the weather has played its part as well. I think our stock levels are right. I think the farmers, although they have been complaining about obviously the load shedding and things like that, they had a good year last year as well. So I think they are still sitting with cash. And then very importantly for us, as we keep talking about it, our manufacturing product sales have increased again. Because this is a combination of traded products plus up to 34%, and it's really on the back of our in-house development that we've been doing, with a real focus on the greener products. And then lastly, on the registrations, we've worked hard in the US for registrations, but also in Europe as well. And we're hoping that a lot of those big plant trials will come to an end as we go through this season, particularly in the US, and we should see the benefits of that coming up soon. So just on the outlook of our agri-business, again, this big drive on softer, greener chemistries, I think we are succeeding in this particular area as well, and I think our customers appreciate that as well. And that should also open up some opportunities for us in the European markets, particularly where this is a key focus. And then, of course, also the focus on margin management, cost management, and working capital as well. Thank you. I'll call up Holger.
Yeah. So before I wrap up, I don't want to miss out to mention our fantastic team, our employees, which all stand behind what we see here as a result. They work hard every day, all of them, and I'm really grateful of having such a fantastic team in a great business. So wrapping up, what is on our list for the second half, and not only? I think the message is hopefully landed. Working capital, is a big theme for us. And we have plans, and management, the executive team has committed itself to really follow through and deliver what we talk about. We also said strengthen the balance sheet. Again, here, I think besides the working capital element that I just mentioned, we talked about, say, prudent capex spend, meaning, and that's important, again, we will not save on any maintenance capex. We will keep this business always in a good shape. This is not a discussion. So what we will do is we will look and review our projects that we have that are not started, and we'll select the best. Like Raphael said, we will check whether they all deliver in the end a ROIC above WACC and create economic value or not. That's how we look to it. We will prioritize our core business, specifically the mining business, to make no disruption in the growth path there. So we will be careful, but we will be prudent, and we will select the right projects, and by that, not spend on the wrong ones. And the other element is that we decided, as Raphael said, a dividend of 100 cents, which is below the previous year. The probably most important of all is that we finally deliver on churn. So I've thrown myself here into the game and involving myself as much as I can and should into that business. And as I said, there are different plans around this. There is no option that we are not considering. So, but our job is to find the best and the most sustainable, profitable way forward for the company. And then just to mention the strategy review. So we are in the middle of a strategy review. Why are we doing that? It is not because we had no strategy. It's because the strategy we had was developed 2018. We all know that since then a few things happened between COVID and energy crisis and up to more geopolitical tensions. That changes the world, and when the world changes, we need to change as well. That's what we do. So we are working on that, and we expect that we are ready to present that, well, we will present that in November on a Capital Markets Day. And actually that brings me to Q&A, and then I want to please ask my team, not my team, we are one team, and the best thing for you guys, that's the challenge now, probably keep my mic on, and if you go closer.
No, you go. Okay.
All right. Okay.
Okay. Thank you everyone for joining us this morning. So it's time for Q&A. So we'll start by taking questions in the room and then try and exhaust that before we take the ones online. Stefan, please go ahead.
Thanks.
If you can please state your name and...
Yeah, sure. So it's Steph Erasmus from Anchor Capital.
Thanks.
Just a question regarding the food and bev business within the... I mean, that's been an issue for quite some time. Maybe, Holger, can you give your views on that? Just what your kind of outlook is for that food and bev division. And then Much Asphalt, the order book, you mentioned that it looked decent. I think Dean mentioned that it looked okay. I mean, what does that mean? I mean, you know, that's one of those... I know Sherm is your focus at the moment, but as you know, Much Asphalt's been much problems up until now. So maybe if you could give us a bit more colour on that, and maybe, you know, is it Sanrail order book? Is it other sort of orders coming in, and kind of what the outlook is there? And then just lastly, in terms of Sherman, I mean, I know it's impossible to forecast, but I mean, you know, those loss levels are starting to get I understand the restructuring and all of that, but I mean, when should we expect, if you don't get rid of it, when should it start turning positive?
Okay, that was three in one. Let me start with food and bev because you asked my opinion. Honestly, I really believe that this is a great business in general that can generate a lot of value. We need to review that, like others, during our strategy work, and then need to make a decision on how to best take that forward. But frankly, from my own experience, and I've been in food as well, it is a good business. So, but how do we create the maximum value for you as shareholders out of that? That should be a result of the strategy work. The much asphalt, I know I can now throw Dean into it, but I don't. Look, as you said quite rightly, and then that connects to Sherm. So our current focus is on Sherm, because this is our, and we not hide that, this is our single biggest problem. Okay, and I think it would not be wise to, if we spread ourselves too thin and start dealing everywhere. So we are now going on Sherm, and we are going to solve that. That's my commitment. The much business is where it is. We see an improvement in volumes. We not see the results that we want to see. Okay, but if you allow, so my focus again is now on Sherm. That's why we brought that forward, and we will bring much forward in the next presentation. That's what we also promised. So then we have a clear, fresh look to it. The Sherm, the answer to what if this business stays, I would say, realistically speaking, we can expect a further improvement over next year. I would say maybe towards the end of next year into 25, we would see real break even, and then a growth that would bring the business back to where it was in the past. So German speaking only. What we should not neglect when we speak about Sherm is the real positive development of the US business. So that is definitely an upside. But no, there is no short-term fix. What we do is a long-term fix, so we are closing a site. That is not an easy thing. Then you need to relocate the production and so on and so forth. Yeah, we are looking now into short-term activities. Like I said, that's the typical stuff you can do, cost, people, price, and we do that. And that shows improvements, but not enough. So it's going to take a bit more time if it's until we see positive. Yeah.
Thanks, Stefan. Another one?
Hi, Talia Ginsberg from Umthombo Wealth. So if I recall correctly, your aim is to get 10% EBIT margins. I believe it's at 7% at the moment. Why do you believe this is possible? I mean, would you have any plans in place, or does it also depend a lot on just the macro environment, like the commodity prices and things like that, which, as you would know, is not exactly in your control?
Yeah, I think as part of the strategy view will help us get there. But if you look at the performance, what's diluting that profitability, as already mentioned, is Sherm. And then, of course, we've talked about much. So if you could strip that out, you will see we're getting closer to 10%. So it's really trying to address strategically, what is, we can see where our core businesses are performing very well, and it's how do we address with the rest.
And then another question on that note. So no, not all of you were, I don't believe, working at the time, but in 2020 you had very big impairments, I think, on mulch asphalt or something like that. Do you believe it's possible to have that sort of quantum of impairments again?
From where we stand at the moment, we have a fairly strong order book. We can see the volume, and as I'm almost repeating what Holger just said, we see the strong order book. We see an improvement in our revenue as well. However, the profitability is in there, and we will have to watch that in the second half of this year.
So you don't see an impairment on Sherm?
Like I said, we're going to have to watch it.
Okay. All right, thank you.
All right, thank you. So we'll take two from online. So the first one is Jovan Jackson from Lorium Capital. What portion of the finance costs relate to short-term debt? Mining generally passes through the costs of ammonia. Are you able to pass on the finance costs relating to holding stock? And then, okay, yeah.
So just to answer the question on financing costs, about a third is relating to short-term.
Okay.
And in terms of the second question, ammonia.
Yes, mining generally passes through the cost of ammonia. Are you able to pass on the finance costs related to that as well?
Yeah, so that's not built into our pricing models, but what we are doing is we are getting our customers more often than not to actually procure the ammonium nitrate up front on their balance sheets. But just to add to that, we are seeing a normalized drop-off in ammonia, so that would naturally have a much better impact on our return on invested capital.
Okay, thank you, Mark and the team. Another one from Wesley Gardner from Resco Asset Management. Regarding locally sourced ammonia, is AECI getting the full allocation needed from its primary supplier, or are external purchases from competitors also required? If the latter, are these at a premium to IPP?
Yeah, so we are getting our allocation currently from our primary supplier in South Africa. And what I can add to that is that recently the delivery of ammonia has been a lot better than it's been where it was towards the end of last year. And we basically priced according to a contractual arrangement, which is very close to IPP.
Okay, thank you. No more questions online. Any other questions in the room? Okay, that's it.
Thank you.
So we're done.
Very good. Then
Thank you, everybody.
thanks a lot for being here, and have a fantastic day.
Thank you.
Thank you.